Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and in case you missed it, we had an amazing investor event a few months ago called Livewire Live. During the event, Desmond from Claremont Global told investors that they should be avoiding hype themes right now, particularly AI. So where should investors be looking instead for opportunities? To find out, we're sitting down with Bob for an episode of The Pitch. Thanks so much for joining us today, Bob.
My pleasure, Ali.
Why should investors be avoiding hype themes right now, particularly AI?
I think there were a lot of very smart people some years back that picked, say, something like Nvidia and could see what was coming down the pipe. And the early investors always, when you get these themes, make really good money. But what tends to happen over time is then the hype really builds up. And I think Warren Buffett's got a great expression: what the smart people do in the beginning, the fools do in the end. And history is littered with so many examples of changing technologies. You can go back to the railroads, you can look at the dot-com boom, lots of areas where you have a life-changing technology, but the investors or speculators who come in late, when that turns, can often lose a lot of capital. So I think this is quite well through. And the second thing I'll just caution on is the capital cycle. So whenever you get hype, a lot of capital will come into a sector, which inevitably lowers returns, just the laws of economics. So I think it's just history. I think if you are involved, just be very careful around that you have a very good grasp of the technology. We don't profess to, and be very clear around your valuations.
Talking about valuation, how do you think about it? And should investors be paying up for stocks with serious momentum behind them, like what we've seen with Nvidia so far, or should they be looking for mispriced opportunities elsewhere?
I mean, obviously we're a quality investor and we do put a lot of emphasis on valuation. So you'd expect me to say, focus on quality and valuation. But I do think where we are in the market now, there's a lot of momentum, there's a lot of good news, a lot is priced in at 22 times on the S&P 500. Stock ownership at its all-time highs in the States. So there's enough flags out there. So basically in the market now, we're saying the soft landing's baked in. And, soft landings historically have been very hard to get right. So if you have any deviation from that, recently there's been a hint that rate cuts may not be as much as people expect, or anything else. If the AI, what often happens is a company misses earnings, or there's an unforeseen event. So for stock markets to keep going up, the news has to keep getting better. So I think this point of the cycle, you really want to focus on quality, balance sheet strength, and most importantly, valuation.
Well, we'll get a little insight into that with companies reporting over the coming weeks. If investors shouldn't be following themes, where should they be invested instead? What makes an amazing investment in your view?
For us, it's always timeless. So we want to buy really high quality businesses that have enduring competitive advantages, that we have a very high degree of confidence in what their earnings will be 3 to 5 years' time, that we're really comfortable with the people who run that business, that they understand competitive advantage, and most importantly, they build a business for the long term and they allocate capital well. Obviously, ethics helps as well. And then again, just pay a good price for that. So that in the end, it's buy quality, buy it at the right price, avoid hype, and think long term.
Do you think about mega themes like decarbonisation or AI? Does that come into your process, or you're only looking at these companies?
Not at all.
Really?
Not at all.
Wow.
We do it all bottom up. So at the end of the day, we're looking for those sort of financial attributes, but then we're also looking for business models we feel comfortable with. And that basically means slow change, enduring competitive advantage. So the thing that's difficult with mega themes, it's very exciting, but the flip side of that change is very rapid. So you have to constantly be on top of that change. And the second derivative of that, you have to pick the winners in that theme. And obviously, once we've discovered that the theme is going to be really exciting, there's a whole lot of other smart people that have discovered that too. And that it's hard to make money out of areas where everyone's crowding. So we prefer to go where there's probably going to be could be some negative news. The company's missed an earnings number. There's a bit of, and that will give us the valuation entry point, and the quality hopefully is enduring.
Are there any mispriced opportunities that you could reveal to our audience today? I know you're a very high conviction manager, so there's not that many stocks in your portfolio, Would you be able to name one or two or three, maybe even, that you are really liking right now?
I mean, I think there are not many mispriced opportunities, I would say, at the moment. I mean, it's the everything going up rally. I do think quality as a whole it looks quite attractive. I can just look at our fund as it stands today. The multiple on the fund is about 5% below its 10-year average. So that's not bad when market's probably around 30% above its long-term average. So I think quality has lagged. And obviously what tends to happen in these types of markets is if everyone's buying all the hype over here, they have to sell the boring quality over here, and they tend to lag. And that's where the opportunities get thrown up.
But are there any stocks that you would actually want to point out?
I would say at the moment, both recently reported at the top of our list, big weightings in the fund, both at reasonable valuations, would be Visa and Alphabet. It's actually interesting, something like Alphabet, people go on about the Mag 7. It's actually trading at a 10% discount to the market as a whole. Just reported very, very strong results. Now, obviously, the concern is around the DOJ inquiry there. We think that will be bogged down in the courts for a very long period of time. And regulatory risk is not something that's new on Alphabet. So it's still reporting good earnings. The valuation's very attractive. The cloud business is starting to scale. Search is still growing double digit. So that's one that we have a good weight in the fund, and we've owned that for 7 years now. Consistently, it's been 8 or 9% of the fund. Still own it, still like it. But obviously there's risk there, and that's why it's attractively priced, because of the DOJ inquiry. And then the second one, which also reported this week, is Visa. And again, another long-term holding of the fund. We've held for a long period of time, just reported very solid results, 8% payment volume growth, double-digit revenue growth, forecasting the same next year. Lots of growth in the new value-added services and new flows, now up to 30% of the business, growing above 20%. And that's trading at just over 10, 15% premium to the market. It normally trades around a 50% premium to the market. And again, you've got a DOJ inquiry there and legislative risk. But again, most of our people we speak to and the legal experts say that's going to be bogged down for a long period of time and very, very hard to prove consumer harm. So those are probably two. They've been long-term stalwarts. They're great businesses and very attractively priced.
Okay, well, thank you so much for your time today, Bob. I really enjoyed that conversation.
Great. Thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.